Well, good morning. Mark Milam here. Happy March the 28th, Saturday morning. I'm coming to you with this week's interest rate summary. I normally do this on the week ending Friday, but that is how busy we were yesterday. Just couldn't take 5 or 10 minutes away from our clients to sit down and make this video, so I wanted to do it today. So, this week, the week ending March the 27th, was the single busiest, most turbulent, confusing, simultaneously positive and negative, and quite frankly, overwhelming week in the history of the mortgage market. Many lenders, including me, are sitting here grateful for the work. We have family members, we have friends, people who are impacted, who are out of work due to this pandemic, and we are busy and we are grateful for that. We're exhausted because we're working around the clock, but we're also trying to get our minds around what is happening in the mortgage market because we've never seen a mortgage interest rate market like the one we're in now. So, what is the one we're in now? How did the week end up? Well, if you're looking for a conforming conventional loan, that's a loan of $510,400 for much of the country, a loan that's saleable to Fannie Mae and Freddie Mac. Boy, you could not have picked a better time. This is a great time to buy. It's a great time to refinance. Rates are at or near all-time lows. Conforming conventional, great. If you're looking for an FHA loan, a VA loan, a USDA loan, a government loan, rates are really, really good for those products as well. You couldn't be picking a better time for one of those products, though we're going to see some more restrictions coming for those products in the coming weeks. Everything else, the jumbo market, which is offered by institutional investors like Wells Fargo or Chase or AIG or SG Capital or Redwood Trust, that market's a bit of a mess, as is the non-QM market. These are exotic products like bank statement loans or alternative credit type financing. Those markets are a bit of a mess. Why are they a bit of a mess? Well, when most folks think about the mortgage market, they think about it like everything under one roof, like if everything moves in the same direction all the time, and that's not really the case. It's more complex than that. Think about different silos like conforming conventional loans, government loans, as we just discussed, these jumbo investors, and then this non QM market. Think about those as four children under the same roof, but they're adopted children. They all look differently, and right now they're all behaving very, very differently. Why are they behaving differently? Well, we know that the Fed stepped in on March the 16th with some quantitative easing, 200 billion worth of mortgage-backed securities designed to bring stability to the mortgage market. And that was like bringing a handgun to a fight. It was a good start, but it wasn't enough to restore order. And the Fed needed to step up with a bazooka and say they will offer unlimited purchases of mortgage-backed securities to help stabilize the mortgage market, and stabilize the market they did. Mortgage-backed securities calmed down. They move to all-time highs, which means rates are pushed or should be pushed to all-time lows, right? So we were all headed in the right direction. But then something else happened, some unintended consequence resulting from the disaster relief bill. Now, this is the $2 trillion bill that's coming out of Congress. And this bill offers forbearance for homeowners affected by COVID-19. In other words, these homeowners could potentially not have to make a mortgage payment for 6 months if they can demonstrate a hardship brought about by the coronavirus. And I think we would all agree that's a great thing for these affected homeowners. But the investors who buy these mortgages are guaranteed to have timely receipt of payment each and every month. And if the homeowner's not going to pay, guess who has to pay? The mortgage servicer. So the mortgage servicer has to step in on behalf of the homeowner and pay mortgage payments to the investor for a period of up to 6 months. There's no way mortgage servicers can do that. And if mortgage servicers can't do that, then who does it? That's Fannie Mae, Freddie Mac, and Ginnie Mae. But that only covers conforming conventional loans and government loans. That doesn't cover all of these other products, these jumbo loans and these non-QM loans. So Fannie Mae and Freddie Mac can simply tap the Treasury to help pay these investors when the homeowner can't. But what happens to these other products? Well, although the relief bill doesn't compel these other investors to offer any kind of forbearance or relief for homeowners, it doesn't offer them any protections either. So what are they doing? They're pulling out of the market is what they're doing. And as they pull out of the market, the interest rates for those products either go up or disappear completely. Right? This is an unintended consequence of the disaster relief bill. We're now seeing an illiquidity in many markets, including non-QM, which are bank statement type loans or alternative credit type loans or anything that's outside of the normal bell curve of the good old-fashioned 30-year fixed. and jumbo investors. We're seeing some jumbo investors simply exit the market or price themselves out of the market due to concerns over what happens if the federal government allows these folks to stop paying their mortgage, but there's no recourse for the lender. How long is this going to keep going on? How long are we going to see this incredible disparity between conforming conventional and government and everything else? Well, we're going to need clarity in the coming week from the Fed and from the Treasury on how the mortgage servicing market is going to access this capital to pay investors. That was supposed to be part of the disaster relief bill, and it wasn't. It's supposed to come in a separate heads up now from the Fed after this bill passes. So, a lot to come this week. Each day feels like a month in this industry. There's always this new information that's coming out. I'll try to convey it to you as clearly as I can until then. If you need any answers to questions or just want to talk through a particular scenario, please don't hesitate to reach out. Mark.milam at northpoint.com. Northpoint has an E on the end of it, 404 395 1102. All right. Thank you. Stay safe. Have a good weekend.